All right, now this is an earnings report we were waiting for, baby. We knew it was going to be huge. We knew it was. We were waiting for Disney for a while because there's a lot to think about with Disney and everything going on with them. The company's undergone, obviously, a rough time period with everything going on. There's no shocker at all. But as we see, the stock continues to climb. Up 5% after hours as well. Still is down on the year. I got to give you credit. Down 20% on the year. But again, this is after it went on a tear at the later half of last year. And we're talking about from 2019 to really at a high point. I mean, this thing went up around 38% in a matter of a year. So it's still at lower levels, but it's valid reasons why it's at lower levels, right? A good portion of their business completely shut down from the physical parks section. So let's look at these earnings and see what it entails. And I got to be honest, I don't know what to say about this, but it's not good. So non-GAAP EPS of 8 cents beats by 75 cents. They're really saying this is a profitable number. I don't know about that. Profitable is interesting to say. It's non-GAAP, so I don't know if I necessarily agree with that. But GAAP EPS of negative 261 misses by $1.63. So this is not an unexpected number, I don't think, for a lot of people. I knew EPS was going to be a miss. I just knew it. And you can say non-GAAP's a beat, and it is, but I typically value companies with GAAP metrics because it's fair for every single company, right? It's the same for everyone. Every company's non-GAAP typically changes, based off of that company reports and doesn't. So, but from a revenue perspective, we saw a 42% decline in revenue year over year. Ugly. 11.78 billion misses by 580 million, so a miss on that as well. I was expecting not necessarily that, but what can you expect? Obviously their business is hurting big time in this quarter where they had no park section at all. So we'll be looking at those breakdowns of revenues. And we love to see it. We love to see what kind of revenue they're able to pull. And as far as Disney Plus subscribers, this is the big story for this company. This is why the shares have turned up. So Disney Plus subscribers came in at 57.75 million versus quarter two, in which they had 33.5 million. So that is a massive, massive growth there in subscribers. We're talking about an add of 24 million subscribers, right? That's a lot. And even the ESPN Plus subscribers was 8.5 million versus 7.9 million, which is weird to think about when there's no sports at all. There's more subscribers for ESPN Plus. Pretty interesting. It's a good sign that they're actually producing content that people are interested. So yeah, definitely. Let's look at some of these finer details as we do. So let's read on here. Oh, sorry, business taken care of. We're good though. So Disney is currently up. Reverse the downward trend there. Revenues were widely expected to crater. Estimates have been revised down heavily, and they did drop 42%. For this report, all eyes were on, again, Disney Plus numbers, which were massive. Below the estimate of 59.4 million. I mean, I don't know in what world that an addition of 24 million subscribers isn't quite good enough for them, but I guess it wasn't. Still, the numbers are beautiful. While the pandemic hit multiple areas of the business, it had a $3.5 billion impact on operating income of parks, experiences, and product engineers. So, in product segment, I should say. What am I saying? Definitely a big portion there. On a GAAP basis, EPS fell massively, as we saw. Revenue by segments in media networks, we saw a 2% decline. Parks, experiences, and entertainment down 85%. I mean, the business was completely wiped out. But products is really what carried that money at all. Studio entertainment down 55%. There were no theaters open, and direct-to-consumer was up 2%. You'd like to see a little bit better number in terms of that, though, for sure. Operating income by segment, we saw media networks rose, parks fell massively. Studio entertainment fell 16%, and direct-to-consumer was negative $706 million. So not nearly as much as the the 1.96 billion from parks and experiences that fell. Can't lie to you, but we also heard from this call that that's right. Bob Chapek dropped a potentially positive bombshell for beaten down investors. It'll put Mulan on Disney Plus in the U.S. and other markets September 4th. Something that they've been waiting on releasing really in theater for a long time. They finally are putting on streaming, which makes sense. The film will come at a premium access price of $29.99 in the U.S., varying slightly in other countries. So definitely payable, but I get it. That makes a lot of sense, and I think it's a very smart idea for them. Very, very smart idea. So very good. We like to see it. Disney finally, or Mulan finally coming out for people. Looking obviously at the earnings report, nothing major here. There's not much we can actually find that's incredible here. I mean, what can I say? The numbers looking ugly. Net loss just looking ugly. EPS ugly, and ugly. So as far as that's concerned, there's not really much I like to point out. By segment, just I mean, it makes me upset to look at this stuff. It really does, because this company is getting smacked. Obviously, they talk about the impact of the virus, and here's a chart, obviously, of the overall change in terms of media networks. 9 months ending, they are up in media networks, and 9 months ending for parks, experiences, and products, they're only down 29%. So you can think of that as a positive, maybe, because it's really just this quarter that screwed it so hard. We were up prior to this quarter. Studio entertainment still up in the past 9 months, which is a good sign for sure. But you're going to see another bad quarter of studio entertainment to come after this, because a lot of places you still can't really, they're not releasing movies. So, what can I say? And direct-to-consumer, obviously doubled year over year because the addition of Disney Plus. What a shocker. We're not shocked by that data at all. So, almost fell there. No, I did not almost fall. You almost fell. Media networks, they break this down too into cable and broadcasting. Cable saw a 10% decline this quarter, while broadcasting saw a 12% increase. Pretty nice there. Cable and broadcasting, nothing significant to really report on those. Parks, experiences, products, definitely just a pain of a segment for them. Entirely due to really these parks being closed. I mean, what else do you want to say? Parks are closed. There's not much they can really do. As far as studio entertainment, they did want to mention here, obviously, no significant titles were released in the current quarter for theatrical, obviously, which isn't a shocker because they purposely were postponing everything, so that's part of the issue, and movie theaters just weren't open. So not really anything major there, but growth in the Disney Plus library, pretty big for them. Obviously, they talk about loss increasing, and that's part of this thing with Disney, and you saw with Netflix really too. Not very profitable as far as the streaming service is concerned, because they're focused more on content than they are on profit right now. And at a price of $5.99 a month, you can only expect so much. So higher results at ESPN Plus were primarily due to subscriber growth. Look at that. ESPN Plus saw growth. Disney Plus good subscriber growth. Can't even rate it so high, but really it's because it's it wasn't there June of 2019. Come on now. ESPN Plus up over 100% year over year. Hulu combined, you see 27% growth, but a big story is live TV there. Seeing growth of 55% on that aspect is good because live television is obviously the more expensive model for them, but it's where people are going instead of cable. So Hulu Live, good to see the growth on that aspect. Very good to see. Other than that, we like to cover the balance sheet, as I should say. I'm a man who's tired. Working at 4 gets you tired sometimes. The amount of just nonsense that they pad this with is what I would find quite incredible. All these consolidated sheets that we just looked at and we already reported on, baby. We don't need these consolidated sheets. I look at them on my own time. One thing you have to notice is the 9 months ending balance sheet. They flooded this with cash. They flooded this balance sheet with cash. And it's something that they really had to do to pay employees, to pay any debts, to pay anything. There's a good reason why they added all of this. So I'm very scared for what the liabilities line looks like. I can't lie to you. Total current assets of $41.3 billion versus $28.1 billion 9 months ago. Total assets in general, though, $207 billion versus $193 billion 9 months ago. So they shifted a lot into assets here. So I'm hopeful that liabilities doesn't rise more than what that $14 billion is there. But I have a bad feeling it will. Current liabilities, you see $30 billion versus $31.3 billion 9 months ago. So there's no growth there. 31. It's the same overall. Current liabilities, nothing massive. And as far as long-term liabilities, that's where we get a little bit of a scare, right? Everything long-term. You do see overall, you gotta mention this, shareholder equity is right at $85 billion, and that's versus $88 billion of 9 months ago. So, to be fair, let's be fair. It didn't change that drastically. The balance sheet's still a good-looking balance sheet. And I like what the company has to offer. I'm just saying that right now. But short-term weakness obviously means long-term gain for this company. And I'm excited for the future of this company. Even at these levels, since my average share price is or lower than, right around 90, I'm not feeling like buying a bunch of this stock. But if you do, I understand your thesis behind it, because this stock should, all things considered after pandemic concerns, go back into growth mode. I mean, this is a thing that reached 153 at one point after being stagnant for years because of Disney Plus. It went into growth mode, and with Disney Plus still a major factor, and it'll continue to be a major factor, I'm super excited on what the future holds for this company. But the short term, we expected bad. We expected it. We knew it was coming, but we'll hang on.